Hey guys, welcome back. In today's video, we are talking about the AMC short squeeze increasing, how Citadel is likely getting squeezed, the price showing at $1,000 again, and many more in this video. First, we're taking a look at this. So recently, what we've seen is a drastic decrease in the shares available. And we talked about how that was because the shorts are borrowing more shares in order to suppress AMC. And you can see a different take on this, or at least Grok's take, where it's suggesting a potential short squeeze as borrowing cost hits near record lows. A phenomenon noted in the 2022 study where linking the low borrowed fees to heightened short squeeze risks. So what we're seeing right now is just another indication of why we're likely to see the short squeeze. Now, there's going to be plenty of other factors that will be talked about throughout these videos, which is supporting these cases, but you can already see how no matter how you look at it, the recent decrease in shares available, the recent increase in the demand for these short sellers to locate shares, to borrow shares, are all showing weaknesses from the shorts, are all showing the increasing impossibility of the squeeze happening very, very soon. And so that's why we have to understand that shorts are panicking right now, is why recently we've seen the increase in FUD. And not to mention, we've also seen the increase in dark pool orders for AMC. Now, AMC dark pool orders, obviously we've talked about this, has already been crazy throughout the last few years, but especially recently, we're seeing it all the time at a very high rate. And you can see in terms of understanding that a increase in the dark pool usage obscures true market demand and may facilitate synthetic share creation. And so this is why we've understood. Firstly, with the increase in the shares available to borrow, we see it when it goes down and it's suddenly increasing. You mix that with the dark pool orders and we understand that it's because they're creating more synthetic shares. And so when you see the share available go from 5 million to 450,000 and then back up to 5 million, it's not because those shares are returned, but rather they were more synthetic shares created to then fit back to the supply. And so that's how we know more and more synthetics are being created every single day. And that's why we've talked about how the squeeze is, of course, accelerating and why the squeeze price will be even higher. And speaking of squeeze, what we're seeing is OCTO set a Nasdaq world record one-day gain of 30x from $1.72 to 72 in one day. Citadel is likely getting squeezed, increasing their position as a delta hedge against their losses, selling the stock short. So what we saw was this particular stock going up, and you guys can see, of 30x in one day, and it's from $172 to $72. Now, the interesting thing about this is one of the institutions who obviously own this is Citadel. Now, we've known with Citadel is that when they take these positions, they are very likely to be net short as opposed to net long, because that's just the sort of firms they are with the strategies that they incorporate. And so when we are seeing this and we suddenly see the share price increasing, you may look on the surface and see that they own 1.84%. But if you were to deep dive into this, it's very likely that they only have this much because they're hedging against their short position. And in this case, when the stock goes up this much, it is very likely that they have lost more money in their shorts than the money they've made from the longs. And once again, because it is a hedge. And so we're very likely seeing them getting squeezed by these positions. And so this is what we talked about with how easily these firms can obviously have their position go in a bad direction, and that's what we're seeing right now with Citadel. Now, bear in mind is that this isn't obviously a situation nearly as big as AMC or GME, and so we're not seeing billions of synthetic shares priced in at $1,000, at $10,000 being squeezed. Of course not, but what we are seeing is how firms like Citadel can easily be caught up into this, and is why, because they understand that this can happen and they understand how much is at risk for AMC and GME, we're constantly seeing them, suppressing AMC. But another thing to note is that if we're seeing them losing more and more money, remember, anything that's tying the liquidity up, anything that's drying up the liquidity, anything that's taking away their money, it's all going to accelerate the progress of squeeze, because if they don't have the money, whether it's to finance the existing short positions, whether it's to create more synthetics or anything else, it's obviously going to make the squeeze happen. And that's why we obviously want to see things like this. Now, another thing is on top of all of this, so we've just talked about about the recent increase in the shares availability in terms of how they're being created more and more every single day. We've talked about Citadel being squeezed. We're also now seeing GME, you can see, with an asking price of $1,078. And so the very interesting thing about this is that when we see these quote unquote glitches, whether it's on AMC, whether it's on GME, it's always during times when something is happening. And so what we're seeing is Citadel is likely being squeezed, and then suddenly GME is showing a $1,078 ask. And the question you can only ask is, why does this happen when certain firms are always involved? When something we see a particular news, now it's not just with Citadel, but it's with any short sellers who's obviously affiliated with AMC or GME, who's involved heavily with synthetics. Anytime something happens to them, we're suddenly seeing glitches popping up for AMC, for GME. And at this point, can we really call it a coincidence anymore? Or is it because as we're seeing them panic and failing with these other positions, they're not able to actually suppress AMC and GME as well as they normally would, because their attention is obviously diverted elsewhere? Now, there's obviously more news on top of GME. Bear in mind that this was ahead of the earnings, but during this, and you can even take a look at the level 2 data, where we actually even saw a $6,000 or even $7,000 price being shown. And this is on level 2 data. And so you can truly understand what is actually happening. And so this is why we've said, when you're seeing weakening in the short sellers, when you're seeing their liquidity being dried out, when you're seeing some of their positions is blowing up, these are good things for us, because it's taken away the ability that they have to suppress AMC, to suppress GME. And so it's very likely that they knew this was going to happen, and it's why recently we've seen the increase of the AMC synthetics, and why we see the increase in the AMC dark pools, because they realize that they are coming into a time where the liquidity is going to get tied up. Now, furthermore, is another thing that's going to put stress on the short sellers, which is NASDAQ files with SEC to allow tokenization and blockchain listing of stocks. And so some of you may see this and think that this is just another way for the short sellers to get out, because we've talked about this in the past with the synthetics. We talked about it with the tokenization, how they use it to obviously locate and then short AMC. However, this time it will be different. Now, I say different because first we have to understand is that I want everyone to understand one thing. Citadel really hates tokenized stocks, and it hurts their business model a lot. And so this is what Big M has said, and we've talked about this in the past as well. What we have to realize is that when we see these tokenization stocks, it's going to be different from what they have right now. And what it's going to do is actually going to show more transparency, and it's actually going to limit the short sellers with what they can do as of right now. So what we have right now is how they're able to locate these stocks and how they're able to borrow it and then short it infinite times over. But what we're seeing is a regulation upon this, and it's actually going to limit the short sellers and bring transparency. Now, does this mean that this is going to be the final thing? Of course not. It's very likely the shorts may try and find another way around this. If the regulations aren't strict on this, they may just turn a blind eye. We'll never know. But I want people to understand that this is not what people think originally, or if you didn't think of it, obviously that's a different story. But if you thought that this is going to be the same as what they have in the past, it's not the same. There are differences, but it just depends on how they obviously spin it. Another thing is the GME. And so we talked about why this earnings, why we've seen big news happen for GME. And so it's why we said potentially we saw this asking price. And essentially it's AMC has distributed warrants as a dividend, where short sellers must deliver an equivalent number of warrants to the owners of the shares they borrowed the lenders. Since shorts don't own the underlying shares, they can't claim the warrants directly. Now, this is very important. So this doesn't technically have the same effect as what we've talked about when you are offering a cash dividend, but this can still force the shorts to cover. The reason for this is because market makers aren't directly forced to locate shares by warrants being issued themselves, but the warrants will get settled by the companies issuing the new shares, not by market makers pulling shares from the flow, and that's actually a better thing. So if a significant number of warrants are exercised and the stock price strongly increased thereafter, the market makers will be off balance and subsequently be forced to hedge or cover short. So that's what we're saying. Now, the difference between this and a cash dividend is understanding that we talked about this with a cash dividend is so that the short sellers have to pay the dividend first to, however many shares they short to the investors. And this is very different, but it can, of course, force them to cover the short shares as they need to deliver these shares. And so that's why we've seen it to be obviously very, very big news. Now, as always, this is financial advice, so do take advice, so make sure to do your own due diligence and research, and I'll catch you guys next time.